Have you ever wondered how ordinary people, the ones you see every day, build lifelong wealth without inventing the next viral app or starting a massive company? Well, here's a secret that's been hiding in plain sight: real estate. From small-town investors to big-city moguls, real estate has quietly made more millionaires in America than almost any other asset class. It's the engine of financial freedom for so many. But before you dive headfirst into this world, you need to understand how the US real estate market truly works and, more importantly, how you can start investing the smart way. So, let's break it down, step by step, and show you the path. First, let's get one thing straight. The US real estate market isn't just one big, monolithic entity. It's a complex, fascinating collection of hundreds, even thousands, of individual micro-markets, and each one behaves completely differently. What works in one city could be a total disaster in another. For example, think about Austin, Texas. During the recent tech boom, property prices there just skyrocketed. People who bought in early saw their net worth explode. Now, compare that to a city like Detroit, Michigan. For years, it was seen as a struggling market, but its incredible affordability attracted a whole new wave of savvy investors who saw potential where others saw problems. They bought low and are now reaping the rewards as the city revitalizes. And the differences don't stop there. Look at states like Florida and Arizona. They're magnets for retirees and cash buyers, creating a steady, reliable demand for certain types of properties. Meanwhile, cities like New York or San Francisco remain ultra-competitive and eye-wateringly expensive. The barrier to entry is high, but the potential for appreciation can be immense if you can get in. The point I'm making is this: location, location, location isn't just a cliche. It's the golden rule of real estate. A great deal in one city could be a terrible investment in another. That's why your most powerful tool as an investor is research. You need to become a detective. Look for clues in the data: population growth, job creation, and local economic trends. These are the indicators that often predict where property values are going to rise next. One of the smartest moves investors are making right now is watching migration patterns. Just follow the people. We're seeing a massive shift, a domestic migration from high-cost states like California and New York to more affordable, business-friendly states like Texas, Florida, and Tennessee. And guess what? Where people move, the demand for housing follows. Jobs follow, businesses follow, and property values follow. Understanding these flows can put you ahead of the curve, allowing you to invest in a market right before it takes off. Now let's talk money, because that's why we're all here, right? Real estate isn't just about the satisfaction of owning a house. It's about building wealth through cash flow and appreciation. There are 4 major ways investors make money in real estate, and when they work together, it's like financial magic. First is cash flow. This is the simplest to understand. It's the money left in your pocket each month from the rent you collect after you've paid all your expenses: your mortgage, property taxes, insurance, and maintenance. Positive cash flow is your financial foundation. It's what pays the bills and keeps the investment running without you having to dip into your own savings. Second is appreciation. This is the long game. It's when the value of your property rises over time due to inflation, demand, and improvements in the area. While cash flow pays you today, appreciation builds your net worth for tomorrow. Third, and this is a big one that many people overlook, are the tax benefits. The US government loves real estate investors, and the tax code reflects that. You can deduct expenses like mortgage interest, property taxes, and repair costs. You can also take advantage of depreciation, which lets you deduct a portion of the property's value each year, even if the property is actually going up in value. This can significantly lower your taxable income. And for advanced investors, there are powerful tools like the 1031 exchange, which lets you sell a property and defer paying capital gains taxes if you reinvest the proceeds into another property. These benefits can save you thousands upon thousands of dollars every single year. Finally, the fourth and most powerful wealth builder: leverage. This is what truly separates real estate from other investments like stocks. Leverage means using borrowed money, usually from a bank, to control a large, expensive asset. Think about it. You don't need $300,000 in cash to buy a $300,000 house. So you're sold on the idea, but you're thinking, I don't have $1 million to buy a huge apartment building. The good news is, you don't need to. There are many different ways to invest in US real estate, and there's a path for almost every budget and every goal. The most traditional path is buying rental properties. This could be a single-family home in a quiet suburb or a small multifamily property, like a duplex or a triplex. Long-term rentals provide stable, consistent income. Alternatively, you could look into short-term rentals like an Airbnb, especially in tourist areas. These can offer much higher income potential, but they also require more hands-on management. If you're looking for a faster-paced strategy, there's house flipping. The concept is simple: buy an undervalued property, renovate it to increase its value, and then sell it for a profit. It can be incredibly lucrative, but it's also risky. You need to be an expert in your local market, accurately estimate renovation costs, and time the market correctly. This is not for the faint of heart, but what if you don't want the hassle of tenants, toilets, and termites? There's a solution for you too. You can invest in REITs, which stands for Real Estate Investment Trusts. These are companies that own or finance massive portfolios of income-producing properties, like shopping malls, office buildings, or apartment complexes. You can buy their shares on the stock market, just like you'd buy shares of Apple or Amazon. You get the benefits of real estate ownership like dividends from rental income without any of the management headaches. A newer and very popular option for beginners is crowdfunding platforms. Sites like Fundrise or Realty Mogul allow you to pool your money with other investors to invest in large-scale real estate projects. You can start with as little as a few $100s and get a piece of a deal that you could never afford on your own. It's a fantastic entry point to learn the ropes. Finally, for more experienced investors with more capital, there's commercial real estate. This includes properties like office buildings, warehouses, or retail centers. The returns can be much higher than residential real estate, but it also requires more expertise, more capital, and a deeper understanding of business leases and economic cycles. So, whether you want to be a hands-on landlord or a completely passive investor, there is a path for everyone. But let's be real for a moment, real estate isn't a guaranteed gold mine. It's an amazing wealth-building tool, but it comes with risks, and many new investors make costly mistakes. Here are the biggest ones to avoid. The number one mistake is buying without truly understanding the market. You fall in love with a house, but you haven't researched job growth, crime rates, or school districts. You have to buy with your head, not your heart. Another huge pitfall is over-leveraging, taking on too much debt too quickly. You see your first property do well, so you immediately buy 5 more, stretching yourself thin. A single unexpected vacancy or a big repair bill could bring your entire portfolio crashing down. Grow at a sustainable pace. Many beginners also ignore the hidden costs. Your only expense isn't the mortgage. You have to account for property taxes, insurance, maintenance, repairs, and vacancy periods when no rent is coming in. A good rule of thumb is the 50% rule. Assume that half of your rental income will go toward expenses other than the mortgage. And perhaps the most common mistake is letting emotions control your decisions instead of math. You get into a bidding war and overpay, or you panic and sell at the first sign of a market dip. Remember, numbers don't lie. If a property doesn't cash flow on paper, with conservative estimates, it won't in real life either. Always calculate your potential return on investment, your capitalization rate, and your cash-on-cash return before you even think about signing a contract. And always have an emergency fund set aside. You will have unexpected repairs. A water heater will break, a tenant will move out. Be prepared. So, how can you get started on this journey? Today, the smart way. The first step isn't buying a property, it's education. Immerse yourself. Read classic books like Rich Dad, Poor Dad. Follow reputable real estate investors on YouTube who show you real deals, with real numbers, the good, the bad, and the ugly. Then, start small. You don't need to hit a home run on your first try. Maybe your first investment is the home you live in now, which you later rent out when you move. Or maybe you try a strategy called house hacking. This is where you buy a duplex, triplex, or fourplex, live in one unit, and rent out the others. The rent from your tenants can cover your entire mortgage, meaning you live for free while building equity in a valuable asset. Next, network. Real estate is a people business. Join local real estate investor meets or online communities like BiggerPockets. You'll find that many of the best deals are found through connections, not through public listings. You'll meet lenders, contractors, and partners who can help you succeed. And finally, learn to run the numbers. Get comfortable with spreadsheets or use online tools like the BiggerPockets calculators to analyze deals. You need to be able to confidently estimate a property's potential returns before you invest a single dollar. And the final, most important tip: don't wait for the perfect time. There will always be a reason to wait. Interest rates are too high, prices are too high, the market is uncertain. But even the best investors in the world started small, and they started with action. The key is to start with knowledge, not with fear. Real estate in the US remains one of the most powerful and proven ways to build long-term generational wealth, not overnight, but over time. So, whether your dream is to own one single rental home to supplement your retirement, or to build an entire portfolio that gives you complete financial freedom, remember this: you're not just buying property, you're buying freedom. You're buying options for your future. If you found this video helpful and are ready to learn more, hit that like button, subscribe for more content on finance and investing, and drop your questions in the comments below. I'll do my best to cover them in a future video. Thanks for watching.